Most passive income videos are going to tell you to buy Dividend stocks, start a vending machine route, or slap some products on Amazon. And look, some of that works. But most of it is advice that was already crowded 5 years ago, and the people repeating it today have never actually run the numbers. So this video is different. We're going to cover 7 passive income ideas that are genuinely working in 2026. And at least 2 of them, I'd be willing to bet you've never heard explained this way before. I've gone deep on the mechanics, the real income ranges, and the parts that other channels conveniently skip. And I'll save the most underrated one for last, because it's the one that almost nobody realizes is sitting right under their feet, sometimes literally. Let's get into it. The first idea is music royalty investing. And before you click off because you think this is for rich people or music industry insiders, stay with me for a second, because the mechanics of how this actually works in 2026 are completely different from what most people picture. Here's what's happening. Royalty Exchange is an online marketplace where songwriters, producers, and rights holders sell their future royalty income to investors through a bidding process. And as a buyer, you get to underwrite a specific catalog before you commit real money. That last part is important. You're not buying blind. You see the verified earnings history, the royalty sources, the trend line, and then you decide what to bid. You can buy into a producer royalty for as little as $10,000 or bid on a 7-figure publishing catalog. The entry point is real, not theoretical. And the returns? Music royalties have historically delivered annualized returns of 13% or more. That's not a cherry-picked outlier. That's the historical average across the platform. The platform has closed over 2,000 transactions and moved more than $200 million in royalty deals. This isn't some niche experiment anymore. It's a functioning market. Now here's where it gets genuinely interesting, and this is the part that changes how you think about music as an asset class entirely. The same market mechanics that let Justin Bieber's catalog sell for $200 million. The same logic that drove Hipgnosis Songs Fund to spend hundreds of millions acquiring catalogs from major artists. Those exact mechanics are now available to regular investors on a smaller scale. One investor on Royalty Exchange reportedly achieved a 55.5% return in under 3 years by holding songs like Touch Me, Tease Me. That's not a stock tip. That's a specific song generating royalty checks owned by a regular person who bid on it through a platform. Those royalties come from streaming, sales, live performances, and licensing in TV, film, and advertising. So when a song gets placed in a Netflix show or a commercial, you collect. When it gets streamed 1 million times this month, you collect. The underlying asset keeps generating because music consumption is evergreen. People stream music regardless of market conditions. But here's something you need to plan around if you go this route, and almost nobody in this space talks about it. Royalties are typically paid quarterly or biannually, providing steady cash flow. But that cadence matters a lot if you're trying to build a month-to-month passive income calendar. If you're expecting deposits like Dividend stocks, you're going to be confused when the first 3 months are quiet and then a check shows up. Know the rhythm going in. Build your cash flow plan around quarterly payments, not monthly ones. Now, the second idea is something that sounds almost too simple, but the numbers are real and the opportunity is genuinely underused, especially because most people who qualify for it have no idea they do. Cell tower leasing. Cell tower leases represent high-value, long-term passive income streams that can last 30 years or more. If a wireless carrier wants to put a tower on your land or on top of a building you own, they will pay you rent every single month with built-in escalation clauses for decades. Rates vary significantly based on location. Urban rooftop leases run $2,500 to $6,500 per month. Suburban macro towers $1,200 to $3,000, and rural ground leases $500 to $1,800 per month. And that's before co-location comes into the picture. Here's the part that most people miss. Typically, cell towers have space for up to 5 wireless tenants, making them valuable vertical real estate assets. So if your tower hosts multiple carriers, you're not just collecting one rent check. You're potentially stacking several on the same footprint. A tower that hosts multiple carriers is a more valuable tower. Every added tenant proves the site matters and makes it less likely any one carrier abandons it. If your lease includes revenue sharing for additional carriers, you collect on that value directly. And Cell towers are generally low maintenance for property owners since the upkeep and repairs are handled by the leasing company. You're not fixing anything. You're not managing anything. You're just cashing a check. So why doesn't everyone with land know about this? Because wireless carriers frequently use their scale to underpay uninformed property owners. There's no public price list. There are no comps you can Google. There is no single standard rent for a cell tower lease. Actual payments depend on many local and technical factors. And wireless carriers do their best to prevent landowners from finding out what they pay, going so far as to add confidentiality provisions in their new leases. That information gap is exactly why getting help matters. Hiring a telecom lease, consultant, or attorney. The $2,000 to $5,000 fee pays for itself many times over on a 25-year lease. That's not optional advice. On a deal worth potentially hundreds of thousands of dollars over the life of the agreement, going in without a consultant is just leaving money on the table. And one more thing about this that almost nobody talks about. The income stream itself is a tradable asset. You don't have to wait 25 years to realize the value. There are yield-focused real estate investors, cell tower lease aggregators like SBA Communications and Landmark Infrastructure, and telecom infrastructure funds that actively buy income streams like yours as financial assets. So if you ever want to exit, there's a market for it. You can sell or leverage the lease almost immediately after signing it. Now let me give you the rehook here, because we're about halfway through and the one coming up is the one I promised at the start. The idea that almost nobody realizes is sitting right under their feet. I'll get there. But first, let's talk about an idea that's been oversold, undersold, and almost universally misunderstood at the same time. Vending machines. Everybody has heard the pitch. Buy a machine, find a location, collect money while you sleep. And here's the thing. There is real money in vending. The U.S. vending industry is valued at roughly $18 billion and continues to grow. But the way it's sold online is one of the most consistently misleading framings in the entire passive income space. And if you go in without understanding the real structure of the business, you're going to burn out fast and sell your machines at a loss 6 months later. Vending is sold as a hands-off money printer, but it's really a small business with real hours, real breakage, and real ways to lose money. That also happens to be one of the closest things to passive income you can start cheaply. That's the honest framing. In the early phase, roughly the first 6 months, you're finding locations, pitching decision makers, installing machines, learning what sells, and making stocking runs yourself. Expect 10 to 20 hours per week of real work per 5 machines. That's a part-time job, not passive income. Now here's where it gets more interesting, because not all vending is created equal. Location quality determines whether a machine earns $75, $750, or even $7,500 a month. Margins shrink fast when commissions are negotiated poorly, inventory sits unsold, or machines require constant repairs. Most first-timers have no framework for judging a good location from a bad one before they sign the placement agreement. High-value locations include manufacturing plants and warehouses, hospitals, car dealerships and auto repair shops, apartment complexes with 200-plus units, and laundromats. Captive audiences with wait time. But here's the angle that almost no passive income video ever separates out from the standard snack machine conversation: specialty vending. PPE vending, tech accessory vending, CBD vending, vape vending. These niche categories are significantly less crowded than the snack machine market, and machines in the right placement can pay for themselves within months rather than years. The category is the same business model, but the competitive landscape is completely different. When everyone is fighting over the hospital break room snack contract, almost nobody is pitching the PPE machine at a construction site. The real passive income version of vending only shows up at scale, and only if you've built the operational layer underneath it. Semi-passive is engineered, not assumed. It starts with dense, well-chosen locations. If you treat it like a real business from day one, it can eventually run without you. If you treat it like a lottery ticket, you'll find out quickly that it isn't one. All right, let's keep building. Because beyond these 3, there are 4 more ideas that are working right now. And they range from things you can start with almost nothing to things that require real capital but pay back in a way that most traditional investments simply don't. If you're getting value from this, drop a comment below with the idea that surprised you most. It genuinely helps the algorithm push this to more people, and I read every comment. And if you want to go deeper on any of these, especially the music royalty mechanics or the cell tower stuff, I've got a related video that breaks down how to actually evaluate these deals before you put money in. It's linked right after this one. Idea 4 is digital products and templates. This one sounds generic, but the version of it that actually works in 2026 is very specific. The people making real recurring income from digital products aren't selling $7 ebooks on Etsy. They're selling high specificity tools, niche spreadsheet systems, industry-specific Notion templates, prompt libraries for specific professional use cases, workflow automation packages for small businesses. The more specific the problem it solves, the less competition, the higher the price point, and the longer the shelf life. A generic budget template competes with 10,000 other generic budget templates. A cash flow tracker built specifically for freelance photographers competes with almost nothing and commands 3 to 5 times the price. The passive part kicks in once the product is built and the distribution channel is set up. A well-placed product on Gumroad, Etsy, or a targeted newsletter can generate sales for years without you touching it again. The work is front-loaded and the income is back-loaded, which is exactly the structure you want. Idea 5 is licensing your photography, video footage, or audio. This one is consistently undervalued because most people who have the raw material, travel photos, nature footage, ambient audio, architectural photography, don't realize there's a functioning market for it. Stock platforms like Shutterstock, Adobe Stock, and Pond5 pay royalties every time your asset is downloaded. A single piece of footage can sell hundreds of times. The income per sale is small, but the catalog compounds over time. Shoot once, get paid indefinitely. The key is volume and searchability. Assets with clear, accurate metadata get found and licensed. Assets buried under vague titles don't. This one also has a higher value lane most people skip entirely: direct licensing. If you have footage or photography that's genuinely unique, a specific location, a rare event, a specific industry setting, you can license it directly to brands, ad agencies, or media companies for significantly more than any stock platform would pay. The ceiling on a single direct license deal is much higher than most people realize. Idea 6 is building a content asset, specifically a YouTube channel or a newsletter, that generates ad revenue, sponsorships, and affiliate income on a rolling basis. Now, I know what you're thinking. That's not passive, that's a job. And you're right, for the first year or two, it is. But here's the thing about content. Unlike most businesses, the work you do today can generate income for years. A video you made 3 years ago can still be pulling in views, ad revenue, and affiliate clicks right now. A newsletter issue you wrote 18 months ago can still be converting subscribers into customers. The asset appreciates with age in a way that almost nothing else does. The passive income version of content only emerges after you've built a real library of work. But when it does, the income-to-hour ratio flips dramatically. The channels and newsletters that look like passive income machines from the outside are usually the result of 2 to 3 years of consistent, unglamorous output. The people who succeed at this treat it like a long game, not a shortcut. Idea 7. And this is the one I've been building toward, is one that has been sitting in the background this entire video, and it connects back to something I mentioned right at the start: high-yield savings and short-duration bond laddering. Before you close the tab, hear me out, because the version of this that's working right now is not your grandfather's savings account strategy, and the numbers are genuinely compelling for anyone who wants true, no-maintenance passive income as a foundation layer. The concept is simple. A bond ladder is a portfolio of bonds with staggered maturity dates, some maturing in 3 months, some in 6, some in 12, some in 2 years. As each bond matures, you reinvest the principal into a new bond at the far end of the ladder. The result is a rolling stream of interest payments and maturing principal that you control on a predictable schedule. You're never locked in long term. You're never scrambling for liquidity, and you're collecting interest the entire time. The reason this belongs on a 2026 passive income list, and the reason it's genuinely underused by people who are chasing fancier ideas, is that it requires almost zero ongoing effort. No machines to stock, no tenants to manage, no bids to place, no algorithms to feed. You set the ladder, you reinvest as bonds mature, and the income flows. It's the infrastructure layer that makes everything else more sustainable. Most serious passive income builders have some version of this running in the background, even if they never talk about it on camera. So let's bring this all together, because I want to make sure you leave with a clear picture of what actually works and why. Music royalties give you access to a real asset class with historically strong returns. Investors earn income from royalty payments generated by streaming, radio play, sales, and licensing deals. But you need to plan around a quarterly payment cadence, not a monthly one. Cell tower leasing is one of the highest value, lowest effort income streams available to landowners, and it can generate $500 to $10, 000 plus per month with built-in escalation, requiring minimal effort. But the lease terms matter enormously over 25 to 50 years, and carriers are sophisticated negotiators who do this for a living. Get professional help. Vending machines are real, but vending is low effort, not no effort. It's really a small business with real hours, real breakage, and real ways to lose money. And the niche categories are where the real opportunity is hiding. Digital products, stock licensing, content assets, and bond laddering each have a specific version that works and a generic version that doesn't. The difference is almost always specificity and patience. What changed from the beginning of this video to now isn't just that you have a list. It's that you have the actual mechanics, the real numbers, the real timelines, and the real traps that most videos in this space never give you. That's the difference between information and a plan. If this gave you something useful, subscribe so you don't miss the next one. I go this deep every time. And seriously, drop a comment with which idea you're most likely to actually try. The engagement helps more than you know, and I genuinely want to know what's landing. The next video I'd point you toward is right up next. It goes into how to evaluate passive income deals before you put any money in, which is exactly where most people get tripped up. Watch that one next.